The sawmill has a cost of $200,000 and a salvage value of 0. It's expected to last 5 years, and once we plug those numbers into the calculator, we get an annual rate of $40,000 per year. Dividing that by 4 to give us our quarterly rate, we get an answer of 10,000. And dividing the 40,000 by 12 to give us a monthly rate leaves us with $3,333 per month. Looking at trucks now, once again we have a historical cost of 200,000. We have salvage value this time of 50,000, and we have an estimated useful life of 10 years. Once again, doing the calculation, 150,000 up top divided by 10 years gives us $15,000 per year. Dividing that number by 4 gives us our quarterly rate. If we were to amortize quarterly, we would be amortizing 3,750 each time, and monthly 15,000 over 12 leaves us with $1,250 per month. Then we get to the fun one, which is land. We do not amortize land, so go ahead and draw a big cross straight to your calculation, and we're simply going to write down $0 per year, also 0, also 0. So never amortize land. The total amortization expense for Jason's company. So the way amortization expense works is we end up having a big number posted on the income statement as an expense. What we're doing here, we're just adding straight down 50,000 plus 40,000 plus 15,000 plus 0, and we're getting an annual amortization expense, which will be $105,000 per year. Quarterly, just take that number, divide that by 4. You'll get 26,250 per quarter. And monthly, take your annual number, divide it by 12. You'll get 87,50. So those will be the annual or quarterly or monthly amortization expenses, depending on how we amortize for Jason's company. Amortization is tied to the financial statement in a number of ways. As the name suggests, with amortization expense, this is an expense which shows up on the income statement. In capital-intensive industries, as we just saw with the sawmill, amortization expense can have a significant impact on earnings. Annual amortization expense can be broken up into smaller pieces if reporting is done more frequently. For example, we divided the annual expense by 4 to get quarterly numbers and by 12 to get monthly numbers. The impact on the cash flow statement. So Amortization reduces earnings, but it does not impact cash flow. In other words, it is a non-cash expense. Therefore, we must add back the amortization expense of the period on our cash flow statement. So we're going to cover this in more detail later. And one more, accumulated amortization. This is a contra account to an asset shown on the balance sheet. The simplest way to think about accumulated amortization is as a means of accounts reporting how much an asset has been used up while still showing it as historical cost on the balance sheet. So let's go into more detail about accumulated amortization. It's an important concept. Using Jason's sawmill as an example, we can gain a clear understanding about how accumulated amortization works. Let's assume that Jason's sawmill is 3 years old. In other words, he is about to start his 4th year of operations. Note that the same amount is amortized off the sawmill under the straight line method. The annual expense we calculated earlier has been amortized off the sawmill 3 times. So we have the annual expense for the sawmill, which was $50,000 per year. And if we use that sawmill for 3 years, we'll have that $50,000 being amortized each year. So accumulated amortization is the total amortization that has been expensed to a capital asset since it was first used. Therefore, the accumulated amortization dash sawmill account should have the following amount in it. So we're going to go into this, but first I want to talk a little bit about this right here. This is the proper way to distinguish accumulated amortization between different assets. So I put down accumulated amortization, and I put a small line, a dash, and I put, say, sawmill. So on your balance sheet, as you're going to see, this will show up as a contra account with no confusion. Down here, we have our calculation to calculate the accumulated amortization at the start of year 4 for Jason and his sawmill. So let's just take 30 seconds here and try this, and we'll go over it in the same video. So we're going to have $50,000 of amortization expense each year for the sawmill. And we're going to go 3 years times 50,000 per year. It'll give us 150,000 of accumulated amortization for the sawmill at the start of year 4. In reality, we should never really be in the position of calculating accumulated amortization in this manner. The balance should build up each reporting period, as we're going to see below. However, it is useful for an accountant to know the simple calculation as a means of checking an account balance for accuracy. If you're having a situation where it's uncertain what should be reported as accumulated amortization under the straight line method for X amount of time, you can do this kind of calculation and verify that the reporting is correct. Is the accumulated amortization calculation a debit or credit amount? Since accumulated amortization is a contra account to a specific capital asset, recall that assets equals debit accounts. Accumulated amortization accounts are always credit accounts. However, they're presented on the debit portion of the balance sheet directly beneath the relevant asset. Here is a portion of Jason's balance sheet as an exhibit. So you see the 3 lines up top identifying this as the balance sheet. And it says December 31st, 2019. This is going to be just at the end of year 3, after Jason has made his adjusting entry for accumulated amortization. So take a minute and see if you can fill this in, and we'll continue in just a short while in the same video. Okay, so the accumulated amortization, as we calculated earlier, at the end of year 3 is going to be 150,000. So the sawmill, your asset, is your debit of $1 million. Your accumulated amortization, sawmill, is your contra account to your asset. So it's a credit of 150,000. Therefore, we have our net book value for the sawmill of 850,000. A few things to note here. So the section of the balance sheet that we just saw, it communicated several things to the user of the financial statements. We saw how much the sawmill cost initially, very important, that's the historical cost. We had an estimate of how much usefulness of the sawmill has already been consumed. So 150,000 has been consumed. And it also gave us the current net value remaining. So we have 850,000 remaining. This type of reporting can give external parties a good indication of when a business may need to replace capital assets and how pricey the purchase might be. Now, let's go back to journal entries and T account to briefly demonstrate how this accumulated amortization balance came to be. After the 4th year of sawmill operation passes, Jason will make another journal entry to record amortization expense for the sawmill. So this is how the journal entry will look like. We have a date, 1 year after our last amortization journal entry for the sawmill. We have amortization expense as our debit. This is our big bucket expense account that's going to encompass all the amortization expense in the company and show it on the income statement. Then we have a specific contra account, accumulated amortization, sawmill. So this is, as you saw, this is a contra account posted just below the sawmill asset on the balance sheet as a credit. And then we have a brief description to record annual amortization on the sawmill. So we're going to fill in the numbers here, and we'll do that in the next video. But also let's have a look at the T account. So we have assets and accumulated amortization sawmill. Again, it's not really an asset, it's a contra account. But then we're going to fill this in. And then we have expenses, amortization expense. We're going to add the sawmill amortization to this expense T account. So take a minute to try that journal entry and filling in the T account, and we will cover all of that in the next video.